Brent Crude just collapsed 9% in one session from $100 to $85. The war premium is evaporating. But here's what most traders miss. The ceasefire isn't a peace deal. One headline flips this entire trade. Brent Crude just did something it hasn't done in months. It collapsed over 9% in a single session, wiping out nearly $15 a barrel from its highs. And right now, at 85.43, there is one danger zone and one hidden opportunity. I'll show you both. Most traders are chasing the downside right now, convinced the war premium is dead. But here's what they're missing. The ceasefire isn't a peace deal. It's a pause. And that changes everything. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today, plus the one headline that flips everything. Let me give you the verdict right now. This market is range-bound with a bearish bias, but the downside is getting stretched. We are trending lower on the 4-hour and 1-hour charts, but the daily and weekly are neutral. That tells me one thing. We are in a transition phase, not a full-blown collapse. Write this number down, $85 even. If we break below 85 today, the entire structure resets and we are looking at a retest of the $80 handle. The herd is positioned long from the spike above 100. Retail traders bought the breakout, and now they're getting squeezed. Hedge funds increased net long positions by roughly 12% over the past 2 weeks, making them vulnerable to exactly this type of reversal. The stop clusters are sitting just below 85. That's where the liquidation accelerates. Just this morning, Reuters reported that Brent fell as low as 87.55 intraday before settling near 88.36. But we are now trading at 85.43, which means the selling has continued into the Asian session. The question is, how much more premium is left to unwind? Let's pull up the weekly chart first. The 200-day moving average sits at 83.04. That is the ultimate line in the sand for the medium-term trend. Above it, we are still in a bull market. Below it, we are entering bear territory. On the daily, price is now trading below the 50-day moving average at 86.57 and the 100-day at 86.36. But here's what's interesting. We are still above the 200-day at 83.04. The moving averages are starting to flatten, which tells me momentum is stalling. Now zoom into the 4-hour chart. This is where the real story lives. We've got a strong sell signal on the 4-hour and 1-hour timeframes. The MACD is showing bearish momentum with a reading of 1.26, but pay attention to the divergence. Price made lower lows, but the MACD histogram is starting to shrink. That's a classic hidden divergence setup that most traders completely miss. The RSI is at 51.5, which is neutral but trending down. The CCI at 20.9 tells me we are not oversold yet. There's room for more downside before we hit extreme levels. And the ADX at 44.1 confirms we have a strong trend in place, but it's losing momentum. Here's what most traders miss. The support and resistance levels from before the escalation are now back in play. Key support sits at 86.28, 85.80, and the big one, $85 flat. Resistance is at 87.84, 88.32, and 89.10. The pivot point is 87.06, which means we are trading well below the pivot. That's bearish price action. The 10-day exponential moving average, which served as reliable support during the uptrend, has now been broken. The next support zone is around $83, which coincides with the 20-day moving average. A break below that signals a potential trend change, and here's the cross-asset linkage you need to understand. When oil drops this hard, the US dollar typically strengthens, which puts pressure on emerging market currencies and commodities. But gold actually rallied during the oil sell-off, gaining over 1% to $4,098 an ounce. That tells me the market is distinguishing between different types of risk. Energy-specific de-escalation doesn't mean the end of macro uncertainty. The VIX is elevated, Bitcoin is tracking risk assets, and the Nasdaq futures are reacting to lower energy prices as a potential inflation relief trade. But don't confuse a geopolitical unwind with a demand collapse. This isn't 2020. The catalyst behind this collapse is straightforward. The United States paused its daily airstrikes on Iran after 13 consecutive days of attacks. President Trump told reporters the U.S. is engaged in good negotiations with Iran and that something very positive could happen. But he also warned that strikes could resume if diplomacy fails. Simultaneously, the Caspian Pipeline Consortium terminal on Russia's Black Sea coast resumed crude loading operations. That terminal is the main export route for Kazakhstan crude, and its reopening added immediate supply relief to the market. The geopolitical risk premium that had been built into prices over the past 2 weeks, estimated at 15 to 20% probability of a significant supply disruption, has been slashed to below 5%. The market is rapidly repricing the worst-case scenario. But here's the critical nuance: the physical flow of oil through the Strait of Hormuz has not meaningfully recovered. Fewer than 10 commodity vessels passed through the strait daily over the weekend. Shippers remain cautious and want greater confidence in vessel safety before sending more tankers through the waterway. And the Houthis just claimed attacks on Saudi Aramco-linked facilities. Saudi air defenses intercepted drones launched from Iraq. This is not a done deal. Looking at the institutional forecasts, Goldman Sachs lowered its fourth-quarter Brent forecast to $80 from $90, while JP Morgan reached a similar conclusion. But Goldman still sees average prices around $85 for 2026. Societe Generale identifies support at $75 to $73 and resistance at $86. ING warns that any price drop may not last long given how supply shortages are worsening from multiple angles. Do you think Brent breaks below $80 this week? Comment yes or no. I'm tracking consensus. Most people skip this section. That's exactly where the money is made. Keep watching. I'm giving you 2 scalping strategies and 1 swing strategy with exact entries, stops, and targets. Write these down or screenshot the screen. You'll need them. Strategy 1, the opening scalp, scalping, high probability. This is for the aggressive trader looking to catch the first move of the session. We are focusing on the 5-minute chart at the 85.43 level. The trigger condition is simple. If price taps 85.50 and prints a bullish engulfing candle on the 5-minute time frame, we enter long. The logic is mean reversion. After a 9% drop, the market is oversold on the intraday time frame. The 85 level is psychological support and it coincides with the bottom of the pre-escalation consolidation range. Here's the exact trade. Entry at 85.50 on confirmation. Stop loss at 85.20, just 10 pips below the trigger. Take profit 1 at 85.90 for a 1 to 1.5 risk reward. If momentum extends, take profit 2 at 86.20. What instantly voids this scalp? If the 5-minute candle closes below 85.40 before we get our bullish engulfing, the setup is invalid. Also, if Trump tweets anything about resumed strikes, this trade is dead. The opening SCLP entry, 85.50, 5M bullish engulfing after the tap, stop loss, 85.20 take profit 1, 85.90 take profit 2, 86.20 risk, reward, 1:1.5 invalidation. Void if 5M candle closes below 85.40. Strategy 2. The liquidity grab, scalping, counter noise. This is my favorite setup of the day, the stop hunt. We're looking at the 15-minute chart for a fake breakout below $85. Here's how it works. 85 is a massive psychological level. There are stop losses stacked just below it from all the retail traders who bought the breakout above 100. The smart money knows this. They will drive price below 85 to trigger those stops, then reverse hard. The entry comes after a fake breakdown, price breaks below 85, prints a long lower wick, and snaps back above 85 in the same candle. That's your confirmation, entry at 85.10 on the snapback. Stop loss at 84.80, just below the wick. Take profit 1 at $86 flat. That's a 90 pip move on a 30 pip risk, nearly 3 to 1. This requires fast execution. If you're not comfortable with quick entries, this isn't for you. But if you can pull the trigger, this is where the real money is made. Warning: if price breaks below 85 and keeps going with no snapback, the setup is void. That's a true breakdown, not a liquidity grab. The liquidity grab entry, 85.10, snap back above 85.00 after fake breakdown, stop loss, 84.80 take profit 1, 86.00 risk reward, 1:3.0 invalidation, void if price closes below 84.80 without snapback. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. Strategy 3, the session swing, trend alignment. Now for the bigger picture, the swing trade. This is based on the daily and 4-hour bias, and it captures the multi-session move that most traders missed. We are currently neutral on the daily and weekly but strong sell on the 4-hour asset data. That means the path of least resistance is down, but we are approaching major support. The swing trade here is a sell the rally setup, not a chase the breakdown. The trigger condition, if price rallies to 87.84, which is our first resistance level, and we get a 4-hour bearish engulfing candle, we enter short. This is the classic sell the failed bounce setup. The logic is simple. The geopolitical premium is unwinding, the fundamental outlook is bearish with major banks targeting $80, and the technicals are aligning. The rally to resistance gives us a favorable entry with a clear invalidation level, entry at 87.84 on confirmation. Stop loss at 88.50, which is above the next resistance level at 88.32. Take profit 1 at $86 flat. That's a 184 pip move. Take profit 2 at 85 even for a more aggressive target. Here's the trailing stop rule. Once price reaches halfway to take profit 1, which is around 86.90, move your stop to break even. This locks in a risk-free trade. The explicit invalidation level that shifts the medium-term outlook. If the daily candle closes above 88.50, the bearish structure is broken and we need to reassess. Also, if the US and Iran announce a formal peace agreement, the geopolitical premium evaporates completely and we could see a flush to $80 or lower. The session SWNG entry, 87.84, for H bearish engulfing at a 1, stop loss, 88.50 take profit 1, 86.00 take profit 2, 85.00 risk, reward, 1 minute and 2.1 second, TP1, 1 minute and 3.2 seconds, TP2, invalidation, void if daily close above 88.50 never risk more than 1 to 2% per trade. Oil is one of the most volatile instruments in the world. The ATR is over $4 right now. Asset data. Scalps demand even tighter risk. No positions through high-impact news like the FOMC decision tomorrow or any unexpected Iran headlines. Stops are non-negotiable. This is how you survive to trade the next big move. Remember, the goal isn't to win every trade. The goal is to manage risk so you're still in the game when the big opportunity arrives. Let me summarize the single most critical level for the next session, $85 even. If we hold above it, we could see a mean reversion bounce toward 86.50 or 87.84. If we break below it with conviction, the next stop is $83, then $80. Here's what I'm watching tomorrow, the FOMC interest rate decision. Markets are defensive heading into that event. If the Fed signals concern about stagflation risks from energy prices, that could strengthen the dollar and put more pressure on oil. If they sound dovish, it could support risk assets and trigger an oil bounce. If this level breaks, $85, the whole monthly trend flips. I'll have the updated blueprint 24 hours from now. If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis and then loop back to today's Nasdaq gamma flip later. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter.